Good afternoon, team, and thank you for joining me. Today, I'm going to provide a high-level summary of GAAP. A financial statement analysis was performed, and during the presentation, I am going to discuss the results of the analysis and the impact on GAP's financial health. I will also discuss performance strengths and weaknesses and some identified positive and negative trends. In order to evaluate financial health, analysis was performed to look at GAP's liquidity, solvency, and profitability. The liquidity analysis was performed to understand how well a company can convert assets into cash and pay debts on a timely basis. I evaluated 4 ratios in order to gauge liquidity, which were the current ratio, quick ratio, cash flow from operations to current liabilities ratio, and inventory turnover ratio. The current ratio indicates to investors that the organization has more assets than they own than money that they owe. The quick ratio focuses on the assets that are easily accessible and can be converted to cash in order to cover the instant obligations. The cash flow from operations to current liabilities ratio demonstrates whether a company can cover debt with the operating income. For all 3 of these ratios, GAAP was successful in improving performance over the quarter. Unfortunately, though, these ratios still fall below the threshold considered optimal for a company. A final ratio is the inventory turnover ratio, which demonstrates how quickly inventory can be sold and converted into real money to pay off debt. It is better to have a large number in this category. GAAP remained relatively flat for the quarter, and while there is no guidance for ideal threshold, GAP's numbers fall below peer companies. A solvency analysis was performed to help demonstrate whether GAAP is positioned to remain in business over the long term given the debt outstanding. Strong solvent companies are able to pay long-term obligations in a timely manner. 3 ratios were used to help assess solvency. The debt-to-equity ratio tells investors how well a company is managing debt. Investors want to see a ratio demonstrating a greater reliance on equity versus taking out debt to fund the business. When shareholders invest, there is no obligation for repayment from the company. When a company takes out debt, the liabilities need to be repaid many times with interest over a set period of time. The debt service coverage ratio measures the ability of a company to produce cash to cover debt payments. Before lenders will create new loans, there needs to be an understanding of how much debt is currently in place. Once again, GAAP improved over the quarter on both of these ratios. However, both ratios were significantly off from the optimal threshold. The times interest earned ratio demonstrates how well a company can fulfill its debt based on current income. The ratio demonstrates how many times the company can use income to pay for the debt. GAAP had a solid third quarter, resulting in strong net income. In addition, GAAP received a sizable tax refund during the quarter, which inflated this ratio. This placed GAAP in a strong solvent position. When analyzed without the tax run, the times interest earned ratio would be at 3.72, still greater than the threshold. While times interest earned is favorable, there are still concerns over GAP's solvency given the results of the other ratios, and lenders should use caution prior to loaning additional capital. A profitability analysis was performed to demonstrate if GAAP is in a position to generate a profit and grow the business. 3 ratios that analyze profitability are the return on assets ratio, return on sales ratio, and asset turnover ratio. The return on assets ratio measures profitability compared to total assets. Investors can use the return on assets ratio to understand how well the organization is using resources to make a profit. The asset turnover ratio measures the asset's productivity and how efficiently the company's property, plant, and equipment are generating sales. The return on sales ratio gives analysts a way to measure how efficiently a company can convert those sales and revenue into profit. Companies need to be able to control expenses to make sure that operational income is generating a net gain. Gap's third quarter performance has once again demonstrated impressive improvement in all three of these ratios. However, the return on asset ratio and asset turnover ratio are still below the threshold. The performance did improve the return on sales. As an investor, I would still use caution and watch Gap to ensure this positive performance continues. Gap presented very favorable results for the third quarter of 2022. A vertical analysis and horizontal analysis were performed to look at improvement over time and improvement as a percentage of total assets and revenues. For the quarter, it was challenging to find weaknesses in the numbers. There were, however, many strengths to look at. For starters, the operating margin ratio improved to 4.86% from a negative 6.25% the prior quarter. While Gap's numbers were lagging peer companies at the end of the year, Gap is showing greater improvement than those same companies. Another strength can be found in the improvement to assets and other current assets, which make up the majority of total current assets. Gap does not break out the category of other current assets on a quarterly basis, but within that number contains accounts receivable and prepaid taxes and prepaid rent. This category of other current assets improved by 19% over the quarter and makes up 11% of the total revenue. A third strength is that Gap is sitting on a positive $1.65 billion in working capital. Working capital is an important financial measurement of liquidity as it demonstrates that Gap is in a position to cover current short-term liabilities such as payroll and accounts payable. The financial analysis helped bring to the surface some positive and negative trends for Gap. Beginning with the positive, net sales has improved by $182 million for the quarter and $96 million versus the same period last year. Selling expenses have remained flat and operating expenses showed a 3% or $185 million improvement from the prior quarter. Taking these three trends into account, Gap was sure to result in a positive net income. In fact, Gap showed a 676% increase in net income over the prior quarter. Another positive trend is that merchandise inventory has decreased 3% over the quarter, a $92 million reduction in assets. While some may feel this is a negative, for Gap it is a necessary move. Inventory has piled up in recent quarters as consumers return to the office. Gap needs to move outdated and seasonal merchandise and free up current assets. This positive trend demonstrates the strategy is working. On the other hand, Gap is demonstrating some negative trends. The most alarming is that Gap is losing cash. Every quarter since Q2 of 2021, Gap has reduced their cash position. It is important for organizations to control cash. Have too little cash and the company cannot stay in business. During the COVID-19 pandemic, many businesses were unprepared and folded due to not having sufficient reserves. Another negative trend is the volatility of the income tax rate. The income tax rate for the 13 weeks ended October 29, 2022 demonstrated a negative 67.9% tax rate. Comparatively, when looking at the 39-week period through the end of Q3 in 2022, the tax rate was a large 174%. This volatility makes it challenging for Gap to control expenses and for investors to have comfort in the core numbers. Based on the assessment of the financial health, company strengths and weaknesses, and the positive and negative trends, Gap should be a company to watch prior to investing or lending. The current results would place Gap as a poor investment choice, but results are improving. Given time, Gap and the industry can improve results and recover from the events of the past few years. Thank you for your time.